Welcome back to the Deep Dive. Today we are opening up the hood on a company that, most people probably file away under boring, but is actually running one of the most aggressive, high-speed growth strategies in the entire S&P 500. We are talking about Arthur J. Gallagher Co.,
The insurance brokers.
the insurance brokers. But if you look at their Q4 2025 earnings report, which
Right.
just dropped, and which we are tearing apart today, it reads less like a sleepy insurance firm and more like a high-growth tech stock.
It really does. The numbers are, well, they're aggressive.
So here's the mission for this deep dive. We have the earnings call transcript from January 30, 2026, the slide deck, and the CFO's commentary.
Right.
We need to figure out how this company just posted its 23rd consecutive quarter of double-digit profit growth. I mean, that is nearly 6 years of uninterrupted compounding growth.
Which is incredibly hard to do in a cyclical industry. And they're doing this while simultaneously digesting the biggest acquisition in the history.
Exactly. So let's get into the numbers. Because the headline revenue growth for the fourth quarter was, well, it was loud, over 30%.
Right.
Now, when I see a mature company, a Fortune 500 company, growing at 30%, my immediate reaction is, okay, what's the catch? Is this real growth or is this just financial engineering?
It's the right question to ask. And the answer is, it's both. To understand Gallagher, you have to split the world into two specific buckets: reported and organic.
Okay, break that down for us.
Reported is everything. It's all the revenue from the companies they bought during the year. But organic, that's the harder metric. It asks, did we actually sell more to the clients we already had? And did we win new clients without, buying them?
So the 30% headline number is massive because they bought a giant company called AssuredPartners.
Correct. The brokerage segment's reported revenue was up 38%. That's the number that grabs the headlines. But if you strip out AssuredPartners and all the other acquisitions, the organic growth was 5%.
Okay, let's pause there. 5%. That sounds fine. I mean, it's solid, but it is a far cry from 30%. If I'm an investor or just an observer, is 5% actually good in this environment?
In a mature, saturated industry like insurance brokerage, 5% is the gold standard.
Really?
Yeah. You have to remember, the global economy isn't growing at 5%. Inflation isn't at 5% anymore. So if they're growing their core book at 5%, it means they aren't just riding the economic wave. They are absolutely taking market share.
They're winning new business.
They're retaining their old clients at a very high rate and winning new ones from competitors.
And looking at the notes here, that 5% matched their guidance exactly, didn't it?
To the decimal. And that is what Wall Street loves about this company: predictability.
Mm-hmm.
But there is another number hidden in the report that I think is even more impressive than the brokerage number. You got to look at the risk management arm, Gallagher Bassett.
Right. That's the claims handling side of the business, the people who deal with the mess when things go wrong.
Exactly. They grew their organic revenue by 7%. Now, just think about what that means. Risk management is a service. You hire them to handle your workers' comp claims, manage litigation.
All the headaches.
All the headaches. And if that business is growing at 7% organically, it means big corporate clients are trusting Gallagher with their most difficult problems.
It signals stickiness. You don't just switch your claims handler lightly. It's too integrated into your HR and legal workflows.
Exactly. Once they're embedded, they stay there. It's a very defensive mode.
Okay, so revenue is vanity, profit is sanity. We see the top line growing, but how much of this cash is actually sticking to the ribs? Because you can grow revenue by just spending wildly.
And that's where the sanity check comes in. Their adjusted EBITDA, which is basically their operating cash flow before all the accounting magic, grew about 30% as well.
Okay.
But here's the metric that matters most: the margin. Specifically in brokerage, their adjusted EBITDA margin hit 32.2%.
32.2%.
Oh,
So for every dollar of revenue they bring in, they keep roughly 32 cents of operating profit.
And crucially, that margin expanded by 50 basis points compared to the same time last year.
Hang on, let's define that for the non-finance listeners. Basis points. We hear that thrown around constantly.
Sure. A basis point is just 0.01%. So 100 basis points is 1%.
So 50 basis points is 0.5%,
Right.
which sounds tiny. Why do we care about 0.5%?
It sounds tiny, but when you're dealing with billions of dollars in revenue, squeezing an extra 0.5% of efficiency out of the machine is worth millions in pure profit.
Right.
It shows they aren't just getting bigger, they're getting more efficient. They're scaling their back office costs better than their revenue is growing.
Which brings us to the elephant in the room.
Yeah.
The reason they're getting so much bigger. The acquisition of AssuredPartners.
The $3.5 billion elephant.
This was a massive deal. And reading through the transcript, It feels like they are moving at breakneck speed to integrate this thing.
Mm-hmm.
Usually when you hear about a merger of this size, you expect a year of transition, right? You expect things to break.
You expect the indigestion phase.
Mm.
Culture clashes, computer systems that don't talk to each other, key employees quitting because they hate the new boss.
Yeah.
But Gallagher is reporting the exact opposite.
They say they're ahead of schedule.
Way ahead. Pat Gallagher, the CEO, gave a detailed update. He said the rebranding of the U.S. retail operations to Gallagher is already done.
Already.
But more importantly, and this is the boring part that actually makes the money, the back office systems are live. HR, payroll, the general ledger.
Okay, general ledger is definitely not sexy. Why does getting that integrated matter so much so fast?
It's the nervous system of the company. If you don't get the acquired company on your financial systems immediately, you don't really know what's happening inside the business. You can't see the cash flow in real time. You can't control costs.
I see.
By getting them on the system in months, not years, Gallagher can immediately start stripping out duplicate costs.
And this is where those synergies come from.
Exactly. They're targeting about $160 million in synergies, cost savings, and revenue boosts by the end of 2026. Okay? And by 2028, they think that number hits $280 million. That's basically found money just by being better together.
So they bought AssuredPartners. They're integrating it rapidly. You would think, logically, the strategy now would be, okay, we spent a fortune. Let's take a nap. Let's let the bank account refill for a year or two.
You would think that would be the prudent move, but you'd be wrong.
I'm not wrong.
Because of something, the CFO, Doug Howell, dropped into the conversation almost casually. He mentioned they have close to $10 billion in dry powder available for M&A over the next 2 years.
Wait, $10 billion with a
Look,
B? Is that just cash sitting in a vault somewhere?
it's a mix of cash on hand and their borrowing capacity credit lines they haven't touched yet. But here's the kicker. They can spend that $10 billion without issuing any new stock.
So they don't have to dilute the current shareholders to keep buying companies.
Not at all. They can fund it all through their own cash flow and debt.
That is a staggering amount of money for an insurance broker. What can you even buy with $10 billion? Are they going to buy a massive competitor?
Well, that's the challenge. One of the analysts actually asked that. How do you even physically spend that much money?
Yeah.
Because Gallagher's bread and butter isn't buying giants.
Right. It's buying the mom and pop agencies.
Exactly. The local insurance broker on Main Street. The CFO estimated it would take over 65 separate deals just to exhaust that capital.
65 deals.
We are talking about what they call micro-targets agencies with under $20 million in revenue.
That sounds like a logistical nightmare, buying 65 separate companies.
The due diligence alone.
It is a machine. They have a dedicated M&A team that does nothing but this. They have a pipeline right now of over 40 term sheets signed or being prepared.
Just from Q4.
Just from Q4. It's like Pac-Man. They just keep eating dots.
But I have to play the skeptic here. Is that sustainable? At what point do you run out of dots?
That's the big question hanging over the industry. But the insurance market is incredibly fragmented. There are still thousands of these small independent agencies in the US, UK, and Australia.
And a lot of them are probably looking for an exit. Many are run by baby boomers who are looking to retire. They don't have kids who want to take over the business. Gallagher is the perfect exit strategy. They show up with a check, a transition plan, and a system to plug you into.
So the growth engine is fueled by buying small guys and plugging them into the big machine. But I want to pivot to the actual product they are selling, insurance. Because if you're a business owner listening to this, you know the market right now is weird.
Weird is a polite way to put it. The earnings report calls it a tale of two markets.
Usually in this industry, we hear it's a hard market, meaning prices are up everywhere.
Yeah.
Or it's a soft market, meaning prices are down everywhere. But they're saying it's both at the same time.
It depends entirely on what you're buying. Let's look at property insurance first. If you own a building, a warehouse, an office complex, good news. Prices are falling.
How much?
They were down about 5% in Q4.
Why? Did the risks go away? Did climate change take a year off?
No, but the immediate disasters did. It was a benign loss year. The U.S. wind season hurricanes was very quiet. No massive storms wiping out Florida or the Gulf Coast. That means the insurance carriers made money, their capital reserves built up, and now they're competing for business again. When they compete, prices drop.
Okay, so property's getting cheaper.
Yeah.
But then you have casualty insurance.
Totally different story. Casualty, which covers liability, lawsuits, people getting hurt on your property, is getting more expensive. Rates were up about 7%.
And that's driven by what? Just Lawsuits?
It's driven by social inflation.
Define that for us.
Social inflation refers to the rising costs of insurance claims resulting from things like increased litigation, broader definitions of liability, and most importantly, juries handing out massive verdicts. We call them nuclear verdicts.
So juries are awarding $50 million, $100 million in damages, and the insurance companies are panicking.
Exactly. And the reinsurers, the massive global companies that insure the insurance companies, are terrified of U.S. liability risks.
I bet.
They're looking at their back books, the reserves they set aside for claims from 2018 or 2019, and realizing they didn't set aside enough money.
So they're hiking rates now to make up for it.
Correct. So if you're a Gallagher client, you're getting a break on your building insurance, but you're paying more to protect yourself from getting sued.
Now, here is where the business model gets interesting, and I want to make sure I understand this. If property prices drop 5%, doesn't Gallagher's commission drop 5%? I mean, they get paid a percentage of the premium.
Right. That is the logical assumption.
Ah.
If the premium shrinks, the commission shrinks. But human behavior kicks in.
Okay.
When the price of property insurance drops, clients don't usually just pocket the saving.
They don't.
No, they opt in, they buy more coverage. Maybe last year, because prices were sky high, they took a huge deductible or they only insured the building for 80% of its value.
Ah, right.
Now that the price dropped, they use that savings to buy the coverage they actually wanted all along.
Ah, so the total premium volume stays the same or even goes up because the client is buying a better product.
Exactly. It stabilizes Gallagher's revenue. It buffers them against the price drops. It's a fascinating psychological safety net for the broker's revenue.
Pat Gallagher, the CEO, had a pretty strong opinion on these market cycles, didn't he? He basically said the whole idea of the cycle is dead.
He did. He said the idea of one super cycle where everything is up or everything is down is a myth now. It's cycles within cycles.
What does that look like?
D&O, which is Directors and Officers Insurance, is bottoming out. Workers' comp is flat, property is down, casualty is up. It's all over the place.
Which, if I'm a business owner, makes my head spin. I can't just read a headline and know what my renewal is going to look like.
And that is exactly why you need a broker. If the market was simple, you could just buy insurance online. When the market is a chaotic patchwork of rising and falling prices, you need a guide. That complexity is job security for Gallagher.
Speaking of job security,
Yeah.
we have to talk about the robot in the room, AI.
The existential dread question.
Yeah.
Yes.
Right. If I could just ask a chatbot to find me the best policy, why am I paying a human broker a fat commission? Pat Gallagher seemed, let's say, defensive about this on the call.
He was defensive, but he was also funny. He compared it to the internet boom in the late 90s. Everyone said, the internet will kill the middleman.
And it didn't.
It didn't. In fact, brokers got bigger.
I love his quote. Everyone is confused because AI lies.
It's blunt, isn't it? But he has a point. His argument is that commercial insurance isn't a commodity like car insurance.
Right.
If you run a construction site and you have a sick employee and a deadline and a complex liability issue, do you want to rely on a chatbot that might be, hallucinating a clause that doesn't exist?
You want a throat to choke.
Yeah.
You want a human who knows your business and has a fiduciary duty to you.
Exactly. He calls it trusted advice. For complex risk, the human element is non-negotiable. But, and this is important, he didn't dismiss AI entirely.
Okay.
He just sees it differently. He sees it as a tool to remove the drudgery.
The paperwork.
The paperwork, the data entry, the summarizing of 100-page policy documents. They rolled out a tool called Gallagher Drive to the new AssuredPartners producers.
And what does that do?
It uses data and AI to help them spot gaps in a client's coverage.
So it makes the broker smarter, not obsolete. It's the Iron Man suit, not the Terminator.
That's the pitch. And in Gallagher Bassett, the claims unit, AI is speeding up claims resolution. If AI can read a medical report and categorize a claim in seconds instead of hours, that saves money and gets the injured worker paid faster.
It seems like the employees aren't too worried about being replaced because their retention numbers are incredibly high.
Dead flat. And that is in an industry where competitors are constantly trying to poach talent. Gallagher has this fascinating farm system. They bring in 600 interns a year.
600, that's a small army.
It is, and they hire about half of them full-time. They are growing their own talent from the ground up, teaching them the Gallagher way rather than just overpaying for senior brokers from competitors.
It creates a culture.
It creates a very specific culture, and it's much cheaper than paying headhunter fees.
Okay, looking ahead, we've covered the M&A, the market, the tech. Where is the growth coming from in 2026? One thing stood out to me in the report. Data centers.
This is a huge vertical for them. Construction is already Gallagher's largest practice, but right now the biggest thing in construction is the infrastructure for the AI boom.
The picks and shovels play. Gallagher isn't building the AI, but they are ensuring the people building the data centers that run the AI.
Precisely. And a data center isn't just a warehouse. It is a nightmare from a risk perspective.
Why? I mean, it's just a building with computers, isn't it?
It's a building packed with incredibly expensive hot electronics that are prone to fire. They consume massive amounts of energy. They rely on complex supply chains for chips.
So the business interruption risk is massive.
Astronomical. If a data center goes down, the costs are huge, so the premiums are very high. And you have real estate risk, technology risk, energy risk. It's an ecosystem. Gallagher helps manage the risk for that entire chain.
So as long as the AI boom requires physical hardware, Gallagher gets a cut.
Exactly.
So 2026 guidance, what are they promising?
More the same. They're forecasting brokerage organic growth around 5.5%, risk management around 7%, and they expect margins to expand another 40 to 60 basis points.
Consistent. But I saw a warning from the CFO about some noise in the first half of the year.
Yes, and this is important for anyone looking at the stock. Noise usually means don't freak out when the numbers look weird.
Walk me through it.
Remember, they spent billions buying AssuredPartners. Before they spent that money, it was sitting in the bank.
And interest rates are decent right now, so that cash was generating investment income.
Exactly. It was free money hitting the bottom line. Now that cash is gone, it's been converted into a company. So in Q1 and Q2 of 2026, they're going to lose that investment income line item.
Which will make the net earnings look a little lower year over year in the short term.
Right. Until the profits from the new company kick in fully to replace that interest. So the advice from the CFO is, look at the underlying business performance, the organic growth, and the margin expansion. Don't let the loss of interest income distract you.
So let's wrap this up. We have a company that is successfully integrating a massive merger, has $10 billion in the war chest, and is navigating a really complex pricing market with solid organic growth.
It's a picture of an incredibly robust machine. For you, the listener, I think there are 3 takeaways. 1, the economy is active. Gallagher's growth suggests businesses are building, hiring, and auditing.
Okay.
2, insurance costs are complex. Your property bill might go down while your liability bill goes up, so don't bank on a flat renewal.
And 3, being the middleman is a great business if you have scale.
Scale is everything here. Scale allows you to invest in the tech that keeps you relevant. It allows you to buy the smaller competitors. It's a flywheel. The bigger Gallagher gets, the easier it is for them to get even bigger.
Which leads to my final, perhaps slightly provocative thought for everyone to chew on. We talked about that $10 billion in dry powder. And we talked about the thousands of small agencies out there. But math is math. At the rate Gallagher and its big competitors Marsh, Aon are consolidating this industry, at what point does the scarcity value of those remaining small agencies shoot up?
That's the danger. Eventually, you run out of cheap dots to eat.
And when the dots get expensive, or when there are no dots left, the growth machine has to find a new fuel source. But for now, the machine is humming.
It sure is.
That is it for this deep dive into Arthur J. Gallagher. Check the show notes if you want to dig into the full transcript yourself. Thanks for listening.
Thanks, everyone.